Welcome to the podcast and, of course, the video. I'm joined by Paul Hill, equity analyst, full-time investor, and sometimes my Twitter troll.
Yeah, sorry about that, Justin. I was just fascinated 2 weeks ago about eEnergy because I hadn't really looked at it, but I saw they hadn't actually released their prelims, and then they had a bit of a bombshell. This was basically after the markets closed last Friday, wasn't it? Do you want to take us through?
Oh yeah, it was a nightmare. I mean, I don't know. I know there's been a couple of reasons why they did that. I've heard different reasons. Harvey said he just wanted to get the news out when the bond thing was done, and since then it's been very painful for me, eEnergy, and but it's one of those things, I love share. One of the low weeks I've had in the last 18 months. Last 18 months have been bloody hard. This week has been one of the hardest weeks I've had in that 18 months. And, you either, get over it and learn, or you give up. And there's no way I'm giving up because I like it too much. So, I updated. In fact, I did my strategy a while back. And like I said, going forward, it's upgrading quality and all that stuff. But it's been hard, and it makes you relook at everything. And so it's been a very big sort of learning week for me. But
yeah, I mean, I've been through it as well. And I think most people have who have sort of like, particularly if you concentrate on small and micro caps, and it can literally take months for you to get out your system. And, that autopsy process whereby you go by learning is absolutely vital. And the pain is absolutely vital, simply because then you really do start sort of like changing your behavior and changing your strategy in terms of the circumstances. And sometimes in a bull market, you can be more sort of like on the other edge, on the sort of the riskier side of things. And then in a bear market, you sort of have to adapt it, etc. But there's sort of like a number of different strategies for investors I would point to. First of all, be really honest with yourself about what level you are. And I would pitch those into three. First of all, sort of like level one, a passive investor who basically you either buy funds or you mirror funds. So if you want to basically go for a cheap and cheerful, no sort of like research, no worry, sleep in bed at night type portfolio, you just go to sort of like, I don't know, Schroders or one of the big investment houses. But just look at their portfolio and just replicate that yourself if you have a significant amount of, reasonable amount of money, and therefore you avoid all the platform fees and you avoid all the other fees, and you're going to hit 8% per annum if you include the sort of like, your dividends. That's your level one. That's sort of like a piece of cake sort of like portfolio. And then I've got level two is where you go half and half. You either go full in like me and you, which is idiosyncratic, or you go into sort of like put your half of all portfolio in more liquid, and then you just mirror it, etc. And then you go your full on level three. And this is where you've got to be absolutely transparent and honest with yourself. Can you value stocks? That's the first thing. Have you got the technical skills to be able to go level three? Next, have you got the risk tolerances to be able to do it? I.e., do you want to take the idiosyncratic risk and the volatility you're going to get to it? And then three, have you got the sort of time horizons? Because these things can stay they can stay unloved for a long time. And that level three is not easy emotionally and technically, and I've been through it, and you've been through it.
Yeah.
And
well, the thing is, I know that it is hard, but this was I should have learned a lesson. I was, I had sort of about 18% of my total portfolio in this company, and sometimes that kind of level, and normally I look for 10, maximum 20, and that's only, now there's different kinds of exposure, of course. Now, I say never put more than 10% of your invested capital of your portfolio value into a company. If it rises to 20% or whatever, it's fine because it's going in the right direction. You haven't invested that. It's not investment capital. But, with this, I started going down, and I was looking at finances, and I thought they're sailing close to the wind as far as nearing. Now, I should have said, take some off and wait until that happens. If they didn't need to raise, fair enough, I could put it back in. But I didn't. And it was almost like a bit of hope guiding me rather than looking at the facts. And in this market, like I said, they raised 12 million at 15 pence 18 months ago. Not a problem. The markets were liquid. Everyone was chucking money into the markets. In this market, and I've talked to so many CEOs who've talked to other people who said it's so hard to raise money. No one wants to invest. So in this environment, you've got to make sure the company you invest in is either generating cash or if they're not, they have plenty of cash, because you don't want to go to the market in this environment. It's so hard. You literally get your trousers pulled down, and that's what's happened here. And there's delays going on. The share price is going down. There's a seller in there constantly. That what's going on here? The seller came out as a previous holder of Elight, which they acquired. And they've had extra spend this year on 3 areas. Energy supply contracts has changed from paying up front to in arrears, all that stuff. They've reintegrated the business, 4 businesses into one, with back office and all that. And they've spent a lot on their proprietary sort of smart meter system. And so they did spend more than they expected to spend, and they did have less cash flow. Saying that, there's some great metrics in there, but going forward, you learn, and even now, like I said, going back, I adjusted my strategy on certain things a while back, and say as a result, Argentex was an investment, and in fact recently on K3 Capital. And looking at certain metrics, it just it makes you better an investor, and you need these. It's funny, investing's very good because you go into it to make money, and if you do it wrong or get it wrong, it hits you right in the place you don't want to be hit, and it takes money off you. And so it's a good leveler, and it's a good learning curve. But going forward, it's always adjust, always tweak, and in this market, it's so important to a company. If they're not generating cash, they've got cash, because they don't want to have to go with their begging bowl somewhere, because they're literally, the terms they can get that cash on is very hard.
Yeah, and also, just coming back to sort of, the point I made in terms of the level 1, 1, 2, and 3, you haven't got to stay in that level all the time. As in, like, if you've been battered and you're in level 3, why don't, if you want to take risk off the table, just go back to level 1. But I would say the level 2 and the level 3, you put on that alpha level, you put on the extra, the alpha layer on top. So rather than making sort of what the market does at level 1, about 8%, you aim for sort of like, 10 to 12% at level 3, and that sort of compounds each year. But when it comes to sort of people like, eEnergy, you'd be looking for a much higher return than 12% because of its size. And I would say, in terms of the work, just having a look at its prelims, it did flag at the interims that it was struggling in terms of its sort of energy supply contracts. So there was a couple of red flags, and then in between you had
they did say there's changing. It changed. But the odd thing is, what's annoying is, previously, like I said, how eEnergy works, they've got different business parts, but one of them is procurement, and essentially they'll consult with the business, and there's supply contracts are very complex. There's many of them, but they've got a reverse auction platform that they say will do about 5 times as many. They'll give you 5 times as many options as any other sort of company. It's not like a broker, they'll do 1 or 2. And so they'll say, okay, this contract looks, pretty good for you, whatever. Then they go to the supplier. Now, the supplier previously would give them a chunk of commission up front on the signing. Because of energy suppliers have been in trouble recently, because they now have contracts that are out of the money for them because the cap is there and they're losing money. They've said, we're not going to do that anymore. We're going to pay you on actual delivery on a monthly basis, which for eEnergy, it's a smooth revenue, going forward. So that's why they've got close to 26 million in order books going forward, which is now above their market cap and the last year's revenue. But of course, that shortfall in cash was the kicker, really, and it took them down. And so
what's your valuation on the shares now?
But if you look at it, it's hard to know. I wouldn't mind with the broken note, but even on if you look at EBITDA, I saw you do a PE ratio of them. At the moment, it's still a newish business, and so I wouldn't go for a PE ratio, but even on a 7.5 times EBITDA right now on 2023, and they say they give guidance for 30 million top line, 5 million EBITDA. So if you do 7.5 times that, what are you at? You're literally at 7 pence there. So it's 48% upside for 2023. So
I would say, this is the other thing, and it's a good point in terms of just broader principle on valuation. When you have a company that is raising really expensive debt, etc., it changes the cost of cost of capital, etc. So if it does that, you can't use an industry multiple, because the other companies in the industry have a different cost structure and a different cost of capital. So you're not looking like for likes, and therefore you have to overlay a risk premium on top of those to be able to reflect its extra. So just doing the rough rule, if it is 15% is your cost of debt, then your 20% is a broad brush sort of level of your cost of your equity you should be putting in, etc. And if that is the case, then just by default, it's a 5 times PE, you know, type of ratio. But I would say, in terms of the one thing this is not for, we both know it's not for widows and orphans at the moment. It could come out and it could do really well. Or alternatively, you know, there's still quite a bit of risk. But I would say if some smart investors like Bob Morton of Hawk Investments doesn't put equity into it, he puts debt into it, that says a lot in terms of how he views it, because he's getting equity style returns, 15% plus, you know, your warrants, etc. And you know, he's not prepared to put any more new fresh capital involved at the lower level of the capital structure. So I would say, in terms of if you're going to buy this share, then I would say, you know, you're looking bake in a really, really high, you know, sort of like potential reward to justify the risk, because obviously Bob Morton is a bright guy.
No, absolutely. I mean, I've changed my thoughts. And when you have to, you know, when you raise debt like that, like I said, the cost of capital goes up. That affects their profits, future profits. Of course it does. And I've changed my mind on it a little bit. You know, I've taken a little bit off. I didn't take a lot off. To be honest, when when the share price drops as it does, it becomes less of a problem exposure-wise in your portfolio. Now it's at about sort of 9% of my portfolio value. So it's but yeah, I mean, they are growing a lot quicker than most competitors and peers. I would say that, and they're long-term recurring contracts. So you know, that also has to be added to the mix. But nevertheless, it's now in my mind, I've changed my opinion on it a little bit because of, you know, that cost of capital going forward. So
and then just, I mean, another broad brush sort of like, you know, sort of takeaway from it, which I think is useful for investors if you operate at this level 3, which I think most of the viewers who you know, listening to this do, certainly you and I do anyway, is, you know, go along to the AGM or vote at the AGM. I mean, you and I probably don't often vote at AGMs simply because we're not no problems with resolutions, because they just, you know, basically they're absolutely fine. But in instances whereby, you know, you have issues, then you raise, if you're a proactive investor, that's the time you basically raise those issues. I mean, I've got, let's be clear about it, I've got some can of worms in my portfolio. I've got Purple Bricks, and I've got basically, you know, Boohoo and Roslin. Now, Roslin is having its AGM on Tuesday, and I've already voted on Roslin because, and I'm not happy. I mean, that Roslin is basically another eEnergy. Let's be clear about it. It's super high risk. And then I've got Purple Bricks, who do have a lot of cash and going through a lot of problems. And they've got a general meeting at the end of December with an activist investor wanting to kick out the chairman. Now, I voted on that as well. So I would say is, if you're in a position like you and I, and AGM's coming up, that is the time democracy, you know, works, because you're probably not the only person who wants changes to that business to get things, you know, sort of like to right size and do it. And I would encourage investors, if you're going to operate at level 3 as a broad brush sort of principle, you know, put your vote out, you know, to show you.
No, do you know what? I wholly agree with that, but I also think prevention is better than cure. You know, and
okay, yes.
And sometimes, you know, literally, I could have avoided this issue quite easily if I'd had less hope and just based it on the figures. And I also that you know, when I did webinars, the figures pretty much a fact. You know, and if you just run the figures, you have seen there was an issue here with cash flow anyway. And I chose to ignore it because I like the growth, I like the sector. There's, you know, the fact is that, you know, the CEO owns over 6% of the stock, so I thought he's not going to do anything silly, but it just shows in this market it's so hard to raise money. And going forward, I'm just, you know, looking at sort of quality filters. I've updated mine, and it will avoid this in future. I mean, you know, there's no way I'll invest in a company that needs cash in the future or has net debt. I won't do that. There's no point, you know. So and now,
but you've got out though. I mean, I know you've been hard on yourself because
that's another thing. You know? Yeah, another thing is, I mean, you know, in microcaps, it's knowing, you know, especially in the bear markets. Like I said, I've gone from like having around about 30 grand, you know, in 2008 to over a 7-figure ISA portfolio. I'm still in a 7-figure ISA portfolio, no problem. So I've done really well, but largely it's been in a bull market, and I'm aware of that. And the bear market like this is a lot different. And when it comes down to it, if you're going to invest, why not just go for really good, healthy, efficient, you know, quality companies that are growing? And that's what I'm heading towards. And so I'm edging away from There will be a time, of course, I understand, when the bull market turns, the micro caps will rally like crazy, and they'll attract lots of liquidity towards them because they'll be getting gains that the bigger caps won't. But I'm happy to avoid that kind of, risk reward scenario. Just go for a bit less reward for a bit less risk, So yeah.
So bigger companies, less debt.
Yeah, I mean, the last two purchases, for example, Argentex is a bit bigger and it has a bit more liquidity. K3 Capital this week is bigger; it has more liquidity. It's operating. The margins are very good. The growth is very good. It's in a very good area. So when I look at companies, it'll be growth, value, the health, of company, the efficiency. Momentum is very important. I've noticed that a lot. I've been looking at companies that have done very well, and literally, unless they get over that, the reason for this is, and you may say it's a technical thing, it's not worth looking at. It absolutely is, because you understand the market. It's not only the fundamentals, but people tend to buy risers and people tend to sell, fallers. So if the fundamentals stack up, but the momentum isn't there with the stock, you could be holding it for a long time, going sideways or even down. So that's also baked in. So I'll have companies that fit all the fundamentals of being, having growth, value, health, efficiency, but they haven't got momentum. And I'll just sit and wait, because it'll come. And how that happens is basically sellers sort of drive, the buyers start picking up and the share price start picking up. So I'm happy to miss that, first 20% at the bottom, trying to find the bottom, because it can go lower. But I'll go with momentum. And so that's another one. And that's same with Argentex and K3 Capital. They had momentum. They're above 200-day moving average. 50-day moving average is crossing up. And that's the more buyers and sellers, net on net. So, listen, it was an avoidable situation. And I had more hope. I still think it's a good business, but I have changed my opinion on it a little bit, because, like I said, now the cost of capital has gone up. And so they're not going to be chucking out as much profit going forward, because they have to service that debt and that bond, those bonds, So
I think if they can reduce their cost of capital, it'll be back to the races. But that's the big if.
Yeah. Well, let's think now. In 2024, when these bonds are due, it'll be a different market. Again, we'll be back in a bull market. There'll be a lot more options, liquidity going around. And like I said, they raised 12 million at a 14% discount. That's all. That was half their size. In 18 months ago. So you see the market has changed massively. And so going forward, of course, it'll be a bullish market. And again, people won't be so risk averse. They'll be back into chucking cash into companies. So yeah, there won't be such a problem.
Anyway, I'm glad to see you've bought some Argentex. Anyway, you've joined me. So I looked at that. The price, I think, got to 120 yesterday. Yeah, it's 121 this morning. So yeah, I mean, it's got a lot.
I've been buying. I mean, I bought it a little bit when it first crossed on that, because I said, 3 times it was covered on Vox. By the way, it was like twice with me and John Human on the screeners, with quality screeners, and then you came on and on this thing, and you covered them. And I thought, okay, so I bought a bit then, and they went up, and I didn't buy a huge amount.
I couldn't buy it. I mean, I think a lot of people
that trading update, which is annoying, but it sort of proved out to say, okay, upscale the quality of company I hold, and also go for the momentum. Try not to pick the bottoming companies, because they can go lower, and they can go lower in a bear market. They can keep going lower for a long time. So So
I tried to buy a full position in them, and I couldn't. So I've only got a half a position. But I interviewed the CEO and the FD about 3 weeks ago or something like that, 2 or 3 weeks, and they're top draw. And to get through the LDI crisis with the sterling crisis on the back of it unscathed is a fantastic achievement for them. And it just shows you the resilience of that business, and to grow your top line 75% in the first half says everything. That is a really sort of like business model that is working. And I presented,
and still good value though. Still good value.
Oh yeah.
7 times EBITDA at the moment. It's growing very quickly, so it's not like highly valued in any way. So they've still got a good run ahead of them, haven't they?
Oh yeah, no, absolutely, yeah. I mean, I got a valuation of 180 on them, and I don't think that's particularly racy either. So yeah, plenty of upside. I mean, I'm on the same page as you. Argentex is one of my top 5 GARP stocks that I presented at the Mello conference only about 2 weeks ago. I've got a lot of hope for it. And you never know these things. If the shares ever come down, they've got a seller in there, I'll be acting as the wicket keeper to buy some more, because I want another half of the position. But You know,
Yeah,
you
well,
can't be.
oddly, do you know, I was looking at the chart on there, and it's something I'm not liking on the chart. They keep going up, hitting that 120, coming back, and I'm thinking they're going to test that top. They're going to break above that previous high, and they're not really doing it with conviction. So I think it may come down a little bit, you know, towards that sort of quid level, and that'd be an opportunity, absolutely opportunity, you know. So
Yeah,
they
nice
need to
Christmas
break
present.
that.
I mean,
Yeah,
another one in that sector that came out with some good news is eQLS, which is the international e-payments platform, and it made a really smart acquisition of a company called Rocket, actually, which is a mini type of PayPal operator. They bought it for about just over £2 million. So it was really, I mean, to be frank, they've been generating so much cash equals, the business model has just been flying, that it was just really almost like loose change to them. So, but what it really does is it's absolutely perfect. It shows two principles. First of all, in this market, it's the strong get stronger. So if you're a business that's unprofitable, which Rocket is, even though you've got really good technology, you know, you're going to struggle raising money. And so consequently, you become, you know, sort of like a potential partner or a bigger company doing better, consolidated at a good price. So, yeah, that shows that principle. You get that, you know, the strong get stronger. But really, on a technology perspective, really what I'm so excited about, I mean, I haven't actually spoken to Ian Strafford-Taylor, the CEO, but what really is a beauty about the deal, in my view, is you've got that platform play for equals in the B2B SME sector. So that's all generally outbound payments through, you know, straight through processing through euros, you know, through sterling into euros and the US dollar and stuff. So that's outbound international payments. This adds the leg of consumer inbound payments. So if they go to a large corporate, and I don't know, let's just say for argument's sake, you know, sort of like Heinz or somebody like that, and they say, like, we'll do all your international payments outbound from your treasury and manage your Forex. But also we can offer on, you know, your customers, if you want to take this platform, if you want to get paid for, say, you know, D2C type payments or B2B type payments, your customers paying you, we can also offer you that technology. So inbound now is being added to the brilliant outbound system. And that's really the beauty of it. This becomes an absolute, you know, just a fabulous end-to-end electronic payments type fintech business. And I'm not sure
that company they bought, is that, I mean, it's obviously got something that they need, but is it a case that a small company like that on its own couldn't exist or do well, and now it's been bought into equals, it can really
because I mean, they're basically like a really small, the technology is like a PayPal, okay? Now they're not going to compete against PayPal because they haven't got the size and the scale and the networking, but their technology is top drawer, and therefore if they couldn't generate the income and the profitability and the timescales required to stay solvent, essentially, probably. And therefore, by becoming part of a larger group, equals, that becomes an excellent solution, because equals can just get that upselling and cross-selling opportunities to their customer base in one fell swoop without having to develop the technology. So it's a win-win for both businesses. But the key is they offer them the inbound B2C type payments so they can offer that to their customers inbound. And then this equals already offer them their customers all the outbound. So that's just like fabulous. I mean, that you can't possibly get better than that. That's such a smart deal for £2 million. It's just, strategically, it's just in this total sweet. Anyway, the shares are ticked up. They're about 90p, 91p this morning. But Ian in the statement did say in the RNS that the business is trading strongly as well so far. So, I mean, I wouldn't be surprised at the year-end trading update sometime, in January, they upgrade their 2023 estimates. They may even upgrade the 2022, but I think there's a good chance they could upgrade the 2023, depending on how much losses they have to absorb for Rocket. I'm not sure, but I think the underlying intrinsic value of that business is getting stronger and stronger by the day.
Yeah, it's, just look at the chart there. It's trying to break that £1 level, isn't it? Several times it's trying to do it. That's, I mean, if you're liking equals, you're not in, wait for a little bit. It may soften before it gets, but eventually, if it does break that, it'll pop above that, and then that's a new trading range, and it'll take it further up. But I mean, like I said, it's tried 1, 2, 3, almost 4 times there. So
I would say, okay, that you're very, the observant on the chart side of it. However, yeah, the only reason why it's had that barriers, had barriers all the way up, is because they've had a large seller called Crystal Amber. And now over the last 18 months, that's sold from 25% they had. They've now got zero. They are totally out. And that was the last RNS. Okay. So when it comes to sort of like new news, it's on, there is not a natural seller now. Because just 25% of that share, those share capital has found new homes, largely into institutions, because a couple of really smart investors who I've interviewed, Ian Staples from Schroders doubled his stake, and likewise James Thorne from Columbia Threadneedle doubled his stake. And I know other institutions will buy as well, because everybody's consistent. The valuation is above 140 here. I mean, I've got 150, but it's over 140. Canaccord and Judith McKenzie at Downing. I mean, we're all saying the same sort of thing. There's plenty of upside. So, yeah, I mean, I know it's come a long way, but there's still upside in this business. I mean, there's probably more upside in Argentex, simply in the short term. But the platform play, I just love for equals.
Yeah. So what are they? So what are they on time EBITDA wise, EV level?
Well, yeah, I mean, you have to look at it sort of like sort of more longer term, because remember their EBITDA is sort of like, they're investing so much in the business. I mean, they should be getting EBITDA margins if ultimately at well over 25%. Okay, they're currently doing for next year around about 19. So there's still plenty of sort of margin expansion. The best metric really to compare it on is on a sales, and I think the sales is going to be increased certainly for next year, and not much on about 2 times sales. So there's still plenty of upside on this one. Anyway, I mean, I think most of the guys who value the businesses are all on about the same sort of level. We all think it's between 140 to 150, that sort of like level. And at 91p, they've got, that shows a bit of upside. It's like Argentex. I mean, I reckon it's 180. I think the Singers have got the brokers got theirs at 160, and the shares that trade at 120.
Yeah, well, if the sellers dropped out, and there's obviously a net buyers there, and there's news comes out on equals, and that should push it up and break that.
Yeah. Well, I hope so. Anyway, we'll wait and see. But hey, you can never, you never tell. I mean, another one which is another sort of GARP stock, did a great acquisition, is Venture Life. Came out with it yesterday, put an inline trading update as well. And it bought a company called HL Healthcare that brings sort of like 3 brands in ear, nose, and throat area into sort of, this is over the counter healthcare products. It bought it for £13 million, a mixture of sort of like upfront cash, a couple of loan note, £2 million of loan notes, and I think 3 million of contingent consideration. But the synergies here again are absolutely great, because ultimately they'll be able to get the cross-selling synergies, because I don't think those 3 brands are particularly sold heavily yet into Europe, and that's a great footprint for the wider group. And then they've also, ultimately they'll start producing as well, in terms of bringing out the third party sort of like, contract manufacturer and manufacturing it for the overseas market in their overseas facilities like Italy or even in Scandinavia. So there's lots of potential synergies. So I think they can even increase the margins on that one. It's going to be immediately earnings accretive, which is actually now something to shout about, because your cost of debt has gone up. Actually, you're putting in a reasonable hurdle rate to make it earnings accretive. So strategic rationale, absolutely perfect. And the financials, absolutely great. And the brokers upgraded its forecasts accordingly. Sales are set to go up about 20% next year, from just over 40 million to just over 50 million in 2023. The EBITDA margin's increasing. In fact, I think the EBIT margin is going up from about 11% to over 15%. So it's showing the operating leverage and the mix effect of bringing those brands on. And Singers have pushed up their price target from 65 to 72p. And I've done a valuation of it, and not a racy one, using 12 to 14 times EBIT for next year's estimate. You add the debt back in, and you get sort of like anywhere between 65 and 77. So I've got a mid price of 71p compared to their 72. So it all ticks, and the shares are only 31, 32p or something like that. So masses of upside in that one. I mean, to get that deal away in this hard environment is you know, you got to tip your hat to these guys.
Well, look at that. It's a shot up yesterday, didn't it? Nice move yesterday on that.
Yeah, well, I'm not surprised because the deal was great. I mean, it is great. It is
20%, and that took it up above the 200 moving average, which is good. You know, marvelous stuff. VLG there. Yeah. What, anything else?
Yeah, well, I mean, the other one which came out with news, which I've, you know, covered quite a few times, which doesn't get that much press, is Lunglife AI, and they basically do that early stage, you know, sort of like lung cancer test. Now, they came out with some pretty landmark sort of like announcement this week that the Medicaid and Medicare, two huge sort of like federal bodies that give sort of like support to the to retirees for healthcare costs, and to sort of like, you know, you disabled and people on dialysis machines and all that kind of stuff. You know, it's either support or free healthcare out in the States. They have approved the lung LB test, which is their flagship early stage lung cancer test, for insurance cover at about $2,000 per test. So they're now commercially all set up. Once they get the green light from their validation study, which the results should be out mid next year in 2023, they'll then be able to start selling this, you know, £2,000 a shop. And they're the only game in town at the moment to give a very good, you know, sort of accurate early stage lung cancer test. The predictive value of these, positive predictive value is at 89%. So, you know, that could open up a real gold mine for them, because this is a huge market out in the States, you know, multi-billion, etc. So a really, really good announcement. The shares haven't moved, which is do shares ever move now on good news? I don't know, but it's you know, a very big landmark achievement. And what it says is not only they're all set up on the commercial side, but equally, you know, the Medicare and Medicaid wouldn't have actually done this unless they thought this was a really valuable test, because you know, that it's a big commitment that they're having to make. So you know, that shows you that they think the technology has got a good chance of coming to market, and clearly, yeah, the management team have. So and their initial pilot gave that indication that it would, but obviously we just got to wait for the results to come through.
Yeah. Nice. By the way, I couldn't go to the I just want to mention XP Factory. They launched. They done so well this year. Fair play. They pretty much hit their target of saying 26 boom battle bars, 27 actually, and boom battle bars this year, in a year, you know, and there were 23 escape hunts. But they opened the flagship store. Obviously, you being a VIP, Paul, you probably went, did you? The flagship store in boom battle bar, Oxford Street. That's phenomenal, really. When you look at what the management have done here, previously, pre-COVID, you know, they were into sort of second tier sort of places, you know, not the prime locations, the shopping centres. And then COVID came along, and of course, landlords had a bit of a problem. They raised some money, and they managed to get into all the best places, you know, across the country, all these premier sites, and including that, it was like slap bang in Oxford Street, you know, 15,000 square feet, and they showed some pictures from that, and it was jam packed with sort of these.
Oh, great.
Yeah, so that's launched, and you know, London compared to some of the regions is a different animal, isn't it? It's like,
yeah, it is.
I used to live in London. You can go out any day of the week, and it's pretty much busy in the central areas. Yeah. And so it's like
any time at night, night as well.
It's a Monday. What are people drinking for?
Yeah.
So that place there in Oxford Street will do good business, very good business, you know. And so it is a flagship store. But yeah, they've hit their sort of operational targets for this year, which is a phenomenal growth rate, and you know, going forward, and good margins as well on all of it. So yeah, I'm looking forward to seeing a trading update from them, because they ticked all their boxes, and so you know. So that's been painful, you know. It's so odd just looking at, when I look back at things. I think if I actually paid attention to a moving average on this, and I bought in 7 pence, so went up to 40 odd pence, and then it sort of decided in a downtrend, and it crossed down about 30 odd pence. The moving averages. I got it then, and now it's about to go back up on trend, but it went under 11 pence at one point, now back to 18 pence or 19 pence. But the COO just bought 14 grand yesterday. So I like it when sort of directors buy. I mean, it's not, it's a decent chunk, but he owns about 150 grand worth. So, but it's nice that they are buying stock. In fact, Argentex happened a while back, didn't it? Director
Yeah.
bought some stock as well at this level, so that's always good. But yeah. So I think longer term that'll do very well. XP Factory.
And what's your sort of outlook broadly then for next year? I mean, given obviously we've both been battered this year, and the market's obviously, sort of higher interest rates and all this sort of stuff. How are you viewing sort of like next year for sort of investing? And obviously you've talked about your strategy, but just more broadly.
Yeah, well, going forward, I mean, I'm just going to continue to look for sort of high growth, small cap, quality companies that are profitable or close to, with plenty of cash. But I don't think the equity markets. I mean, when I say make sure you have companies that have got cash, or if they're not generating cash, they have cash, because there are better markets than to raise money in. And I think it'll be tight for a while. I think it'll struggle for a while. I don't think it'll just free up overnight. I mean, like I said, the Fed mentioned, didn't they? They're going to ease down on the interest rate hikes, and the market rallied. I don't think we've seen the bottom of the S&P yet. I really don't. I think it'll move down, because I think financial reports will come out quite bearish, because it's still an expensive environment. If you are, again, it's a stock picker's market, isn't it? If you are in a company that is consumer facing, it's discretionary, it's not going to go gangbusters, because people are feeling the pinch. So you just got to be careful what stocks you. I think it'll be literally, you've got to be very selective on the stocks you pick, and look at companies that are not going to be affected by cost of living crisis and all that stuff, or energy prices, all that stuff. So yeah.
Have you ever looked at the bond market at all? Have you ever looked at sort of like investing money into sort of like corporate bonds or in treasuries?
No, I never have really.
I mean, just to give you an indication, I mean, if you'd been on the other side of that eEnergy and you're putting debt in at 15% plus warrants, I mean, that sounds a pretty nice deal to me.
No, yeah, it does. Yes, I know. They didn't offer me any of that. The first thing I knew about it when it came out on the Friday evening. I was so annoyed by that. I was taking my son to basketball lessons, and someone said, "Have you seen this?" So I was half driving. So God, I thought, Friday evening. Why would you do that?
5:40, wasn't it?
I know.
Yeah, but you can still buy. I mean, let's be clear about it. You can buy. I mean, it depends how you want to go the risk it. But Carnival Cruises is a multi-billion-pound business. You can buy its traded debt at 12%. You can buy. I mean, last time I looked at NatWest's corporate bonds traded on the over-the-counter bulletin sort of like exchange. That they're about 7 or 8% yields, and that's not bad.
Do you know? Yeah, Carnival actually is odd, because I was speaking to a mother at the school my son's at, and she works for Carnival Cruises.
Oh right.
I was saying, how's it going there? She said, well, they're cheap at the moment. This is before they come up with I think they come up with some news on debt or whatever. So it's cheap at the moment. I said, yeah, I think people are just worried about the debt, aren't they? I said, yeah, but trouble is, it's funny how you took the employees. The trouble is, though, compared to other cruises, we own our boats, and a lot of companies don't. They all also own an island. Most cruises do. They own an island, which is very odd. But I mean, someone did say about Carnival, be aware of the depreciation or amortization levels of those, because I think 25 years or something. But and so no one's. Who told me that? So no one's going to want to go on a boat 25 years old. So that cycle, the depreciation cycle, is a bit long. But yeah,
but if you can get 8% or 10%, you're coming up the capital structure, then that's actually, and if you chuck it, if you buy it in your SIP or buy it in your ISA, you're not paying any income tax on it, and therefore you get it basically straight as an after-tax return in those tax wrappers. That's not a stupid return.
No. I mean, but I've got some bit of cash now. I've sold out. Like I said a while back, I sold out of Biome. I've sold out to Polarean now, because I just don't want to take the risk of that FDA approval going wrong. I've reduced on Gfinity, so I've got some cash, and I'm just sitting doing nothing with it really at the moment. I'm just looking for stocks. But do you hold any bonds?
I've owned them in the past, definitely, but they've been very sort of opportunistic. I mean, I'm very happy to take. Not very happy, but I take a lot of idiosyncratic risk on the stock side, so I tend to go for that. I mean, my only sort of like, I would go more in short-term corporate debt, if I had the choice, yeah, simply because you're not then taking as much of the credit risk if we do go through a hard recession, which I don't think will happen. But the moment we're not sort of factoring in a really hard credit cycle, so sort of short-term corporate bonds at sort of investment grade, I would go for. But I'd stay away from gilts, and I'd also stay away from treasuries. And the reason is because both central banks are actually selling those assets, you know, in quantitative tightening.
Yeah.
And when you have a natural, very large seller, regardless of what the economics does, you're basically going to get those prices selling off and the yields going up. So I've got a sneaky suspicion it's going to be hard sledging in those sovereign debt markets for some time. But for the corporate side, I could actually see those, you know, those yields are not stupid, to be perfectly honest. And they might well be, just if I want to come off some of the high octane risk, and let's be clear about it, you and I have both got high octane risky stocks in our portfolios. If I want to come off that, then this is not a stupid place to park some money in corporate bonds with investment grade institutions, you know, and you just buy them straight on the stock market and just pick up the interest, pick up the clip on it, 8%, 9%. I mean, in a short term, that's not bad.
There's also, I mean, if you know, in stuff like that, a bit more less risk as well. There is previously I have invested in a high dividend fund on BlackRock. You know, there's IUKD is ticker there, but and it pays about, I think it was 5% pretty much, but it's, you know, it's largely across all the big companies. Yeah, no, really, I'm sitting there, but to me, I like shares. I do like shares, and I like companies, and I suppose, but you still do research with bonds, I suppose. But yeah, things I'm looking at. I mean, I literally, like FUTR PLC come out with their results.
Yeah.
I haven't taken any of that, and it went lower on the day, and it's still in a little bit of it's not. I think it's hit the bottom here on the share price. But you know, all the metrics were decent, but I think there's just a worry out there. Couple of reasons, you know, advertising, going through a recession, all that stuff, even though they had less sort of traffic, but they're so efficient as a company, their platforms, they acquire companies and to give it a bit of makeover, do what they call the platform effect to it, and they can monetize it, higher rates, all that stuff. So it's very efficient. You know, checks out a lot of cash. I mean, adjusted operating profit up 39% at 271 million. You know, and revenues up. I mean, largely through acquisition from 600 million to 825 million. It's all going in the right direction. They're taking on a bit more debt, but it's like 1.5 times EBITDA. It's not a huge amount. But I think this is a company that's, you know, that when the CEO took over, that's another worry that she's leaving the end of 2023, but I can't see that being a bit of a problem. But she took the share from 2014, it was £1 a share, went up to 39 quid a share. So she's obviously, you know, people regard her as something of a special source there. But
she's a rock star CEO, absolutely.
Yeah, exactly. So, but
Zilla, I think her name is, isn't it? Zilla?
Yeah, Zilla Bing Thorne, I think it is.
Yeah.
But it's one of those companies that, like I said, it's not a one-person operation now. It's, you know, it's the business model is very embedded. They know what they're doing. So I just think a recovery in this kind of stock, which is chucking out cash, it's growing still, and going forward they'll still be doing the same thing they've been doing. So just sitting on the sidelines having patience. It could go lower if the market goes lower, you know, because
well, that comes down to exactly what you said earlier on with regards to momentum, isn't it?
Yeah, momentum. That's what I'm waiting for here. Yeah, I mean, it's not above its 200-day moving average. It's struggling to get above that, and it's not even touched it. So I've
had a few fund managers mentioning about future very positively off air. So I don't think you're the only person looking at it, actually, because I think last time I saw it's trading on a PE of less than 10 for such a good quality business growing so strongly.
Well, that's what I said, you know, so you can have companies fundamentally doing well, releasing results, but the market, you know, can lag a little bit or not give it its dues because it's just the worry, you know, about going forward. So why bother getting in now when it can go lower? Just wait for basically what momentum is more net buyers and sellers. And when that starts happening, it pushes the price up. Now that aligned with good fundamentals is good, you know, because I've got it in the companies before. The fundamentals are good, but the share price is in a downtrend. It's continued to go in a downtrend, and it can be painful. So, you know, why try and grab that? Why trying to find the bottom? People try and do that a lot. It's a false economy. It's not worth doing, you know. It's
yeah, I don't try and find a bottom, but I'm happy to take it that I'm just prepared to say I'm never going to buy at the bottom and I'm never going to sell at the top. And if I can actually do well in between, I'm happy. So there's many stocks I've owned where the shares have continued selling off, and they've been 50, 60% down just on momentum after I bought it. And then they've done really well. I mean, so I'm just not good enough to be able to say I want a significant chunk of shares when I want to buy, and then on that basis, I just buy when I think the valuation and the fundamentals looking really attractive compared to the buy, and just prepared to hold it. And that's why I coming back to sort of what we started with. When you go to level 1, level 2, level 3, level 3 involves idiosyncratic risk and basically price value staying out of line. Sort of like you've got to be prepared to have long-term time horizons.
It's not far off. I mean, look at that. The EV EBITDA is 8 on the current things. The EBITDA margins are 33%. So very decent. They've got some net debt of 423 million, but that's, like I said, 1.5 times. But yet they just need to get above that 16 quid level. Once they start doing that, I think they'll start going. But there we are. That's future. Anything else happening?
No, that's great. Well, best of luck. And do
you know about K3 Capital? Have you heard of them?
Yeah, no, they're basically a financial services. They do sort of restructuring, and they're a good quality business. They've got a good reputation, as I understand.
Well, market cap at 220, EV 208, but 30 million cash. But the revenue went up by 50% to 70.7 million. They got gross margin 65, EBITDA of 30. They're not absolutely cheap, but they've had a compound annual growth over the last 5 years, revenue 45%. Even on operating margins, it's been a compound annual growth of 28% over the last 5 years. And they're about 10 EV EBITDA, but they are number one business advisor. I was looking at their presentation; it was very impressive actually, because got 3 sections of the business. They've got business, sales, M&A, all that stuff. They advise on that, tax, anything like that, and also insolvency and restructuring.
The insolvency one is he's going like a train for them.
Yeah, but they're looking at the stat on business sales. Very interesting. They took it back like 10 years. And they were showing the amount of activity across 10 years, and it doesn't really dip. Even during financial crashes, business activity, M&A, is still quite good. It dips from top to bottom by 10%, but their activity in that level has gone up from like 2.6 million per year in annual sales to about 20 million now the last 5-6 years. So they're really picking up, and they are number one now by deals in that space, and they're quite a bit above everyone else. But worth looking at, because the chart after 18 months of going down is starting to come back around now and starting to power up a bit. So
and what percentage? What percentage of your
dividend?
Yeah, good. What percentage of your portfolio is K3?
They are not a lot at the moment. Let's have a look.
Okay, so it's one you might add to later on, depending on how they go.
3%.
Yeah, okay. So you might add to it then.
Yeah. Cool.
Well, you never know. You might get into equals at some point and crest you, but probably not.
Yeah, well, and I should have gone into it a lot earlier. Do you know what? Like I said, I missed the boat on those and the quality companies, and I'm not saying there's not more to go. I'm not saying that.
Yeah.
It was like I said, when I first spoke to Krestick, I thought, and I thought I had it wrong. I thought it's quite cheap. That they were like, and all of a sudden they came up with an update. Again, it just went off. And I thought, oh God. So
Well, another important principle to close on, and I think this is a really good one because you've just raised it. Yeah, you haven't got to swing for everything.
Exactly. Yeah.
And as long as you swing for the ones you want to swing, go for, and overall your portfolio over a long period does what you want to do, that's fine. You're doing great. Don't have this fear of missing out kind of rubbish.
That's it. Yeah. Well, do you know what? I upgraded my filters of that. I thought I'll probably miss out on some of the hope pipe potential stocks that I've done quite well on previously. But I thought, it doesn't matter though now.
No.
My portfolio is bigger, and I can't get in. I can't get the positions in those stocks anyway that I need to change. But I'm better off going for a low risk, low return than going to try and go for 200-300% or something like that. Because
no, I would agree. Yeah, I'm going to knock the ball out every time and get a few singles.
Yeah, just be consistent. That's it. Yeah. And there we are. And at the moment, I've been consistently bad for the last 18 months. So
we've all been there. We've all been there.
Marvelous. Cheers for that, fella. Speak in a couple of weeks.
Bye.